Hello, I'm Anthony, founder at Seedlegals, and I talk to thousands of founders at Seedlegals about valuations, fundraising, finding investors, creating great pitch and storytellings, and so on. And I happened to be at an event in New York run by Nina, where she was talking about very similar things. And I thought that advice is fantastic. We should get together and do a podcast together. So welcome, Nina. Tell us about yourself and how you help founders, particularly in the US, fundraise.
Thanks, Anthony. Yeah, I appreciate it. It was great having you at our event. And then after we met and started chatting and everything, we realized how complementary, what we do at LionRun Consulting, and I'll explain that in a sec, and what you guys do at Seedlegals, how complementary it is and how important kind of both work is for founders to be knowledgeable on as they're preparing to fundraise and throughout their raise. So quick background. So I'm Nina, I'm the founder and CEO of LionRun Consulting. LionRun Consulting helps typically earlier stage founders anywhere from seed to Series B to prepare to fundraise. So really an A to Z approach from doing all the right research, the strategy, building out all the investor materials, all the way to even more of like the design implementation and really perfecting all of the pitch materials and the pitch prep. We've worked with over 250 companies that have raised over $500 million. So we've definitely seen a lot of similarities, with what we see between challenges that founders face. And that's really what has driven our approach and really what we do with our clients. And, after we spoke, a lot of that stuff that you guys do at Seedlegals is also just as important and goes hand in hand with the work that we do as well.
Okay, so in the next 30 minutes, if you're a founder watching this, we're going to cover, should you raise investment? Do you go to angels or VCs? How to create a winning pitch deck? Cap table issues, questions, how many investors to have you on your cap table, and more. So let's start with, should you raise investment in the first place? I mean, it's kind of seems like an obvious one, but I'll go first and then I'll hand over to you, which is one of the big problems the founders have is the story of your life is you go to investors and they say, love what you're doing, come back later. And actually, not having to raise investment is better than having to raise investment. So at the beginning, you put your own money into the company. But the problem is, unless you're independently wealthy, you are going to reach the limit of the amount of your money you can put in. And for sure, you're going to find the rate of growth of the company is limited. So when we started Seedlegals, my business partner and I each started putting our own money in, $1,000 a month, then $2,000, then $5,000, then $10,000. Pretty soon you're going to have a discussion with your wife or husband about where that money's going, and it's time to raise investment. So, bootstrap until you get to the valuation is high enough that you can raise enough to not dilute yourself too much. And now you can use someone else's money to help build the company faster than using your own. So Nina, thoughts on that? What do you see when founders come to you? How often do you say, keep bootstrapping, don't raise yet, it's too early?
Yeah, it's a great question. So really what we see is the main reason behind why founders would need to fundraise. And as you mentioned, if you don't need to fundraise, that's a good thing. That means you're growing a sustainable, profitable business. So in the case that a founder does need to fundraise, typically that means that they've hit some sort of glass ceiling in which they can't grow their company any farther unless they have some sort of external capital to be able to hit a specific milestone. For an example, like if you're building something that is very hardware heavy, you might need a lot of capital to be able to build the actual product. In that case, you can't necessarily fund it yourself. Or let's say it's a biotech and you need to get FDA approval or hit some sort of specific milestone which needs substantial capital. That's usually the reason why typically you would need to fundraise. So when you want to fundraise, it's not all what I like to say smiles and handshakes and press releases. It's a very difficult thing. So if you're considering it or thinking about it, you really want to look inwards into your business and understand of what is this going to do for your business and what is the real reason. And if you get that external capital, what are you going to do with it and how are you going to use that to be able to hit that next milestone? And is it possible to do it without? Because if it is, then that's even better. But if not, then that's where you will go through kind of down the fundraising rabbit hole, which is a whole art in itself.
Okay, so one of the interesting places I see people sort of thinking they only need to raise once ever, which never really happens, is you've got a company that's worked on some product. They now get a big enterprise customer, the big ticket, maybe a $500,000 purchase, which will make them profitable. But in order to be able to deliver that service, they need more investment in tech and so on. So they've got the strange catch-22 where you think you need a certain amount of money in order to deliver the service, and then you'll be profitable afterwards. I have to say, it's very rare that I've seen companies only ever need one funding round. I do see founders think they're going to need one funding round, but actually few fast-growing companies never raise. Again, you keep growing and you keep raising. So now, at the event we're at, you spoke, Nina, about companies being like an onion with multiple layers. Tell me about the onion layers.
Yeah, so essentially, like one of my favorite analogies is that a startup is like an onion. And similar to like an onion, there's different layers that make up your business. And the startup is like a ball of risk. And essentially what you're doing is each layer of your business is, at least from an investor perspective, can be considered a layer of risk. So what it is, the job of the founder is essentially to peel back each layer of risk and be able to address each layer. And then at the core, that's really the opportunity of what the potential that your company can do. When an investor is evaluating a company, they are trying to peel back each layer. So for example, that could be the market risk, that could be the financial risk, it could be the technological risk, or the team, maybe, or something like a financial hurdle. And typically when founders, let's say, pitching to an investor, they're trying to almost like avoid addressing those risks. But really what I advise for, at least for our clients, is to really think about what is those layers that you think you'll get stumped on by an investor, and try to hit those head on. Like those are the big things that you should be addressing. You shouldn't be shying away from that, because if it's something that keeps you up at night, it's definitely going to be a flag that an investor is going to raise. So try to do your best to, when you're thinking about your company and you're preparing for your raise, try to peel back as many layers as possible, so then you can really show the investor what is the actual opportunity of your company.
That is a really great point, because I think as a founder, you're always used to selling the dream. We're going to change this, AI, something, going to change this. But actually for an investor, some will be seduced just by the dream, but many will be thinking about all the risks. And so if you address them head on, so you would presumably, you wouldn't have in your pitch deck, risk and how we sort it. You would more in an abstract way to, for example, we've got a great founding team who are super experienced, thereby ticking the box of inexperienced founding team. We've validated the product with 100 people. Great. We've validated the product risk. You might try to show as far as possible that you can raise that next round from multiple investors, or you've got future pipeline, or, your tech is sorted. So each of these, imagine in your mind, you've got these 5 layers or 5 class of things to tick off. And as you're creating your pitch deck, you're not going, we've ticked this off, but the investor in their mind, as they're seeing the slides, going, oh, that one's sorted, that one's sorted. And at the end, if there are fewer risks, that means the valuation is higher and the chance that they will invest is higher as well.
Yeah, exactly. Another point is, it's really the message that you want to convey is, how is this investment going to then de-risk the company for future growth and for, at some point a potential exit. And that's really like the core of what an investor's interest is. They're looking to get a return on their investment, and that's what you need to show.
Okay. So let's now talk from, instead of risk mitigation, to founder storytelling. So to me, the pitch to an investor, whether it's in, a verbal pitch or a pitch deck or a meeting, it's about the art of the story. And to me, a pitch sequence is like a Netflix series. The goal of episode 1 is to get you to watch episode 2, and episode 2 is 3. And it all starts with an outreach. It could be a warm intro. It could be a cold outreach. It could be a chance meeting. And there it's going to be just a little teaser to get the next meeting. And that might be to now go through the product and the pitch. And then might come the DD and so on afterwards. So let's turn, Nina, to you on that storytelling, the problem, the solution, that how it works. How do you help founders construct that story?
Definitely. So one of the biggest challenges that we see founders face, and really what the biggest struggle is that our clients face when they initially come to us, is, again, it's telling their story. And what we will see is a lot of times a founder will think that what they say doesn't actually match up what they actually are saying and how they're explaining the company. And usually it's because a founder's technological knowledge of their product, or knowledge in general about their product or what the company is doing, is so deep in the trenches, and the difficulty is peeling back to understand what is the core of what they're doing and how do you explain it in the most simplest form. So when it comes to the pitch deck structure, I can give you a little bit of a sneak peek in terms of like how we like to structure the deck creation. You can think of it actually tangibly in the structure of the pitch deck. You can also think about it more high level when just building out your company story. That we always, typically within the first 4 slides of a deck, is really where the story is built. And it comes down to really, how do you explain 4 slides? And the first slide is usually your problem. Second slide then goes into your solution. Fourth slide goes into the how it works. And then it goes into the actual value proposition. So when you first are looking at the problem, it's usually an example of, a one-liner with the highest quantifiable impact of the problem that is occurring. Then you go into the solution. It's usually we do X by achieving Y in order to, it's a very structured, very simple sentence. The how it works, we usually break it up into 3 to 5 steps. And then the value proposition, it's usually around 3 specific pillars. And there's a lot I can go into the nitty-gritty of each of these, which I'm happy to go into if you would like, but that's essentially the high level. And then the rest of the story really flows. But usually what we see is the struggles really starts within the first 4 slides. Once that's nailed down, everything else really comes together.
Okay, so I love hearing it put that way. What I often find is you talk to a founder and they explain eloquently the problem, doctor, dialysis machine, mother, something didn't work, working on sorting it, world will be better. And then you look at the pitch deck, and the pitch deck, that problem solution is drowning in a sea of technical stuff and acronyms that nobody understands, and AI and blockchain, and the pitch deck does a less good job than just listening to the person. So you want that pitch deck to really tell the story. And I learned this with Seedlegals. When we started Seedlegals, the first version of my website said, we do contract automation and document generation. And then one day I woke up and thought, hang on a second, 0 people get up in the morning and go, you know what I need today? Document generation. Doesn't happen. And the problem is founders who are often technical like to explain how clever they are and how clever their team is, but nobody cares. And when you realize that, then you change things around. So I then redid the Seedlegals website to go the fastest way to close your next funding round. And then there's some nice screenshots of how it works. And suddenly you've turned an abstract thing into a solution to a problem the person is seeing. Now, the investor in your pitch deck is probably not your customer, but the investor is going to be thinking like a customer. And if they see that you can't express a customer proposition, they're not going to invest because they know you're not going to be able to sell to customers. So just to wrap up on this, I like all presentations to really be of the form, something is broken. It's insane. We've fixed it by X. And with nice lifestyle images, and the lifestyle image can really bring it to life, because if you get the right image, person sitting at their desk, don't use one of those awful stock images from Shutterstock, go off to Unsplash or somewhere and find a nice image. But, with a mobile phone or a computer with your app clearly visible on it, and suddenly it just becomes obvious what it is. So, for example, I was talking to a company that does software for construction sites, and they were explaining it was all very complicated. But I mean, if you've got a person standing next to an SUV with a phone or a computer on the bonnet of the hood, whatever it is, of the SUV, with a building and a crane in the background. It's completely obvious what this is about. And so just using imagery and clear wording about how you're solving a problem changes everything. And then you've got the investor hooked on the first couple of slides, and hopefully they'll make it through to the end if you don't go on for too long. All right.
I was going to say that goes right hand in hand with what you just mentioned. My biggest piece of advice, especially for highly technical companies, is focusing on what you do, not necessarily how you do it. Because the how will come. If they want to know about it, they will ask, and then that will open up room for conversation. But think about what is the essence, what's the core of what you're doing, and that's what's going to get you a more concise and clean solution of how to explain your company versus diving into, oh, we do it through this, and this. Well, no one really cares. They just want to know what it does. And then if they want to know the actual technological backing of how it actually happens, then you can explain it. But it's really making that difference between the what and the how.
Exactly. And by the way, the art of storytelling, your pitch deck can be so much more powerful by just changing the titles of the slides from problem, solution, market size, fundraising or something, to things that would be like signposts in a story. Such and such is broken. How are we fixing it? The market is enormous. We're much better than the competitors. Meet the amazing team. Here's how we plan to grow more, and so on. How we plan to expand over the next few years, rather than just noun titles for each slide. So now let's swap to the materials that you need when you talk to investors. So it's all well having a nice slide deck. Investors are probably going to ask you for other stuff as well. And then, you help companies prepare the pack of other things they need. Tell us what materials they need.
Yeah, so I'll kind of take it in the order of the actual communication process with an investor if you were to be fundraising. So typically you start out, let's say, with a one-pager, which gives just the highlights about your company that will spark interest, and which you can use for like any sort of introductions when you're looking for warm intros, or if you're doing any sort of cold outreach. Let's say you were to get a meeting. Let's say it's a 30-minute Zoom meeting with an investor. So in that case, you don't want a huge comprehensive 20-slide deck because it's going to be more conversational, but you do want to have at least what we call a presentation teaser deck, which is pretty short. It's usually no more than like 8 slides, which just gives, again, a little bit more information on the highlights, and you can use that as a complement to your narration and your storytelling. Then after that, let's say they get a go-ahead from their fund to want to do some deep due diligence. Typically, then they'll ask for your actual, like a full, more comprehensive deck, which is what we call the master deck. And then also some sort of like financial projections. And then essentially, typically they'll ask for access to a data room. So for those who aren't familiar with a data room, essentially it's kind of like a virtual library that has all the documents about your company. And that's where, they'll be able to do a very, very deep dive into the company. And typically in the data room, you want things like a investment memo / a business memorandum, like a business plan. That's where you'll also include any sort of legal documentation, which Anthony can also touch on in terms of that, and your cap table and so on and so forth. So I guess now, Anthony, on your end, kind of from more of the legal side, what type of documentation would you say would need to be included in the data room?
Thanks for the prompts. But just before that, I love your thoughts on, that shorter deck for the investor 30-minute presentation. Because one of the things I hear from investors is that founders get on a call with them and then proceed to speak at them for the entire 30 minutes, which is super boring, leaves no time for Q&A, and also means that the founders don't know anything about the investors, just talking. So my top tip from talking to investors is, first, before you start talking about the pitch or going through the pitch, start talking to the investor about what they're looking for. Because once you understand that, then you know how to tweak your pitch to tap into the things they're looking for. And the investors would love to talk as well. They just sitting there most of the time waiting for people to talk at them. So are you a lead investor or a follow investor? This is critical, because if it's a follow investor, which 95% are, they're never going to invest until you found a lead investor. So you want to get them warm on the call. But if it's a lead investor, you're going to try to see if you can turn this into something that will close with them, and then you can go back to your follow investors. You can ask them which things, which areas they invest in. What's the typical fund size? What's the ticket size? And now you know, I mean, if they tell you their minimum check size is $10 million and you're only raising $3 million, you're kind of wasting your time. So you're going to talk about, well, we're going to be too early for this raise for you, but we'd love to talk to you later. So we know it's a longer, term relationship and so on, and you're not wasting time. And then by them telling you whether they're really focused on saving the planet or making money or investing in super cool things, you'll tweak your pitch accordingly. Then you might talk for 10 minutes going through that pitch. And then you've got 10 minutes or more for Q&A at the end, which not only will be great for the investor to ask those questions, but really valuable for you to get feedback from the investor. Because if you keep talking at investors and none of them reply, or they all go, you're too early, come back later, you've learned nothing. You're just going to rinse and repeat. So you want to get as much feedback as possible. So now, turning to the legals, of course, you want your cap table sorted. If the investor might ask to see the cap table. If it's just two founders, it's pretty easy. If you send them a spreadsheet, it looks less professional than sending it, for example, here's my Seedlegals cap table. Investors are going to want to know that you've got founder agreements with share vesting, with IP assignment, so that if one of the founders leaves, which happens all too frequently, the business doesn't fall apart. They need to give back or cancel some of their shares. The IP is all assigned to the company. The founders are all working full-time for the company, or if not, they're showing that as soon as there is investment, they'll give up their day job. So there are a certain set of due diligence things that if you tick the box on it, it's smooth sailing. And if you're caught out on it, it's like, okay, that was a mess. And a typical one I see at Seedlegals is that founders haven't got their founder agreements. And that means there is an awkward discussion, sometimes even playing out visibly on the pitch deck where you can't see who's CEO and who's CTO because they haven't had that awkward conversation yet. So get that all in place. And, Seedlegals is there to help on all of that. All right. Any questions on the legal side that you see, Nina?
I think actually just going a little bit back to one of the points that you brought up when understanding, also asking questions from the investor to understand more about what they're looking for. 2 points. One, on that end, that's actually an emphasis that we really kind of talk to our clients about, is doing the right investor research. And actually that's something that it's part of our process, because you want to make sure, you're not wasting anyone's time and you fully understand, what they're looking for and if you're actually a good fit. And it's not only are you a good fit for them, but are they a good fit for you? Because it's like a match, and it's kind of like when investors invest in your company, it's kind of like a marriage in the sense of they're going to be involved in your journey for quite some time. So on that end, and also another thing that I also kind of like to bring up is that if you ask for advice, you might get money, or may get usually you might get money, or if you ask for money, you'll get advice. So a lot of times, like if we'll make an introduction for one of our clients to an investor, really kind of try to tell them to approach that conversation as more open-ended, get feedback on the actual company and on the product from them first, and ask for advice of like, hey, what are you looking for? What do you like to see? Well, how can we improve? Because, usually you're talking to, if you're fundraising, especially from VCs, you're going to have a lot of conversations. So it's probably more valuable to initially get advice first and get that feedback, because you're going to want to iterate over time. And then on the investor research side of things, like you mentioned, once you have an understanding of who you're speaking to, then you can tailor your pitch. And that's something that we actually very frequently do with our clients, and make many variations of their decks and of their materials, depending on the angle of the investor that they're speaking to.
I like that because people often just have one slide deck, but investors are vastly different. VCs, angels. I mean, one day there'll be AI that will make a custom version of the deck for every investor that they will just be blown away how the deck was just perfect for them. So let's switch before we wrap up to should you find VCs or should you go after angel investors? And Nina, with your company, are you helping companies founders find principally VCs or angel investors? And when is it right to switch from angels to VCs?
So, in terms of that question, I don't think it's a one size fits all where, like, if you're doing X, Y, and Z, then you go to an angel investor. And if you're doing X, Y, and Z, then you go to a VC. I think it really comes down to what the investor is looking for and also what you actually need. So, obviously, if you're trying to do a larger round, depending on the actual company, you might need to go to VCs. Usually at that earlier stage, that pre-seed round, typically we see the funding coming from angels. So family, friends, private investors that are putting in, a few $100K here or there, or even less. And then once you get into, I would say, like your seed, Series A, Series B, that's typically comprised of VCs. But at the same time, sometimes you have pre-seed VCs that's their focus. So I don't think it's a one size fits all. I think it's like really what you need and how much capital you need and the actual approach and what type of company you are, in which sometimes VCs won't even touch. In that case, you need to go to angels. And I also think it's every fund and investor has different preferences. So it's more, like I mentioned, it's not only are you a good fit for them, but are they a good fit for you?
All right, great point. And I must say, for me, my advice is that founders don't know any angel investors. So you do some Googling, you find all those investor lists on the internet, and then you start reaching out to VCs. And if you do get a response from the VC, it's often love what you're doing, come back later. The story of your life. And the reality is, with rare exception, VCs only invest once the company's got revenue, which then gives you the catch-22. How do you get investment to get in developers and so on to get to revenue? And for that, there's angel investors. And angel investors, like everyone, is a potential angel investor from a few $1,000s, upwards. So at that point, you now are going to, don't not reach out to some VCs, but as soon as you start seeing some feedback saying come back later, you're going to waste much of your life trying to rinse and repeat, trying to find that perfect frog to kiss to get to the next step, when instead of out there kissing frogs, you can be reaching out to angel investors. And there, it's about making as much noise as you can on the internet. Write articles, content marketing, blog posts, LinkedIn posts, then use SDR, sales development representatives for LinkedIn outreach, or of course, reach out yourself. Don't say, I'm developing X and I'd love to send you the pitch deck, because that's going to get a delete or, not accept the request. But try to create something personalized to each person you're reaching out to, saying, hey, I noticed you wrote an article on this, or I was reading your article on that, and I'm working on something in the space. Can I tell you more? And if people reach out to me and say, hey, Anthony, can I send you a pitch deck? It's like, why? But if they say, I've seen one of your videos and you were talking about legal tech doing something here and I'm working on that, can I tell you more? It's like, oh, the person's researched me. This is relevant. This could be interesting. They've done their homework. Sure. And so that's your episode 1 of that Netflix series. All right. Now, Nina, how can people get in touch with you and why should they contact you?
Yeah, for sure. So, you can get in touch with me via LinkedIn or our website, LionRunConsulting.com. Like I mentioned, we're typically working with companies anywhere from C to Series B to be able to fully help them prepare to fundraise and put them in the best position to successfully raise and to be able to approach investors. So, whether you're struggling in telling your company's story, whether you're kind of lost and this is your first time raising and you need that extra guidance, like we have a very structured 3-phase process in which we build out all of the materials, do all the research, all the strategy, all the design work, all the copywriting and storytelling all combined into one process. So that's a little bit about us, and we love what we do. We're passionate about it, and so if you're building and you kind of fit that category, you can get in touch with us.
Amazing. So for helping get investment ready and creating that awesome pitch deck and connect with investors, Nina's there to help. Once you've got investment intent, Seedlegals is there to help with all the legals, the documents for closing your funding round, whether it's safes or a priced round. We're in the US, we're in the UK, we're in France and in Ireland. So any companies in those countries, we can help with all the documentation for your funding round, cap table, and more. And head over to seedlegals.com or Anthony Rose on LinkedIn, or just hit me up on email, anthony@seedlegals. Nina, thank you so much. This has been very useful. I love the conversation, and hopefully it's helpful for founders to get investment and grow their businesses. Thanks.
Awesome. Thanks, Anthony.